welcome to another Taxes in Retirement Live. I am Andy Panko, owner of Tenant Financial. You may or may not notice new background. I am in the new office space. My first time doing anything live from the new office space. Super exciting. Just finally getting stuff settled, things on the walls, computer setup, phone setup, whatever. So, but yeah, this is lighting's not ideal, but good enough for now. So hopefully you all can see me well. Tonight's topic is all about annuities, and I was putting the slides together for this. I realized this should probably be broken up into 2 or 3 weeks. So I'm going to try to go through it now. I tried to make it as concise as possible, but each of the different annuity types I'm going to be discussing ideally could and should be its own. But we'll give it a go, see what happens. Worst case, I'll just break this up in the future and do it into separate things. Let me start you with the disclosure. This video is only general explanations and education. It is not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. I'm just some guy here talking about annuities on Facebook, not doling out any specific advice or recommendations for anyone. Let me just see if comments are working. Yes, they are. Very cool. Okay. Dad jokes. I did not bring my dad joke book with me. That's at my other office, my home office, but I do have some dad jokes I pulled down online when I got here. They're all wife themed. No particular reason. These are just ones I found and they all seemed good. My wife is blaming me for ruining her birthday, and that's ridiculous. I didn't even know it was her birthday. You get it? Next, my wife said we should split up because I keep pretending I'm a detective. I said, good idea. We can cover more ground that way. She would not like it if I said that. And next, so my wife said, I need to do more chores around the house. I said, can we change the subject? So she said, okay, more chores around the house need to be done by you. She just got real grammatical with me on that. So that's the dad jokes. I see people are trickling in here, 36 sets of eyeballs watching currently. As I've been doing, I will run through the presentation. Lots of pretty slides and graphs to help bring it to life. I do anticipate there'll be lots of questions. Just please save till the end if possible, because otherwise it's going to get, the flow will get broken up a lot here. Thank you, Mavis. I know office. When it's all done, I'm going to actually do, not that many people may care, but I'm going to do a little video tour and save it, show it for you all now. You're just seeing kind of the back wall here with my stuff. Okay. Thank you. Nice ad jokes. Thank you, Renell Davis. Cool. Very kind of you. All right, so let's get into it without wasting too much time here. Tonight's topic is annuities, and I want to start by saying, so I don't sell annuities. I have no insurance licenses, so I'm not, biased because I'm selling this stuff to people. And there's people in the opposite camp that hate annuities at all costs, and some of that is justified. But to be fair, there's so many different types of annuities that do very different things. So it's not fair to lump all annuities in the same bucket and call them all a 9-letter word. There are some that are worse than others. There are some that are really good. Like any product or tool, it has its place. It's not right for everyone. It's not right all the time. It's in some cases it's bad for people, but they do have their place when used and used properly. So tonight's, what I'm going to do is, if I can just ask you to the extent possible, wipe away any preconceived notion or opinions or even knowledge you have of annuities. Let's just start from the ground up and go about it that way. And I think you'll see they can be really valuable tools in the right situation, the right type of annuity for your specific circumstances, et cetera. So let's get in and go from there. So let me pull up my screen share. Share screen. Window, okay, share, and we're good. So I actually have 2 monitors now at this setup. So I got one just pulling the PowerPoint, one just with you all, so I can little easier to navigate this stuff now. So there's really only 2 common denominators across all annuities. Again, I'm going to get into the different types, but there's really just 2 things that bind annuities together. Outside of that, they can be drastically different. One is they're a contract with an insurance company. They're not an investment. They're not a mutual fund. They're not an ETF. They're not a stock or bond. It is a contract, a contract between party A and party B, you and the insurance company. That's an annuity. The other big common denominator is any gains that happen within the contract you have with the insurance company All the taxes on that are deferred until you eventually take money out. That's when taxation may start. So if you have an annuity for 10 years, you plop money in the beginning, you don't take anything out along the way, there's zero tax on anything that accrues or builds or credits inside that annuity. I won't get too much into the taxation. This can get squirrely pretty fast. How the money's taxed when it comes out. I mean, that could be a separate topic, or if you have questions, feel free to jump in at the end with it. But just know that that's one of the big, I don't need to say, not necessarily benefit, but one of the features of annuities is it's tax deferred. Now, for what it's worth, all those gains, they're not long-term capital gains. It's not an investment, like I said. Any gains, when you eventually take it out, will be taxed as ordinary income. There's no concept of reduced long-term capital gains in annuities. They just flat out don't work like that. So those are the two things to, I'm trying really hard to be unbiased. Yeah, just please, to the extent you can, open mind for this, everybody. So thank you. I appreciate the honesty, Kenan. Okay, so those are the only, maybe there's some other smaller things, but practically speaking, these are the only two things that annuities have in common. Outside of this, it's like, whoo, the sky's the limit with how different they could be. So I'm going to, there's 4 types, 4.5. I'll discuss that half in a second. And I'm going to go through each of these 4 today. One is a multi-year guaranteed annuity. One is an income annuity. One is an indexed annuity. One is a variable annuity. Now, I say there's 4.5 because there's something called a buffer annuity or structured annuity, maybe the term. It all depends what the insurer chooses to call it. But that kind of sits halfway between indexed and variable. It's part indexed, part variable. I'll touch on that a little as I start discussing indexed and variable. So real simple. Let me start with multi-year guaranteed annuity. Oh, I'm sorry. And then for these other 3 types, so for the income, the indexed, and variable, there's then 2 subsets of flavors, if you will. There's immediate and deferred. Immediate basically just means if and when you take income from it, you're taking it soon after you buy the annuity. Deferred means you're plopping the money in, you're letting it sit, letting it bake, letting it hopefully grow, and then you're deferring the start of income until some point down the road. So for each of those flavors, again, there's 2 kind of subsets. Multi-year guaranteed annuity doesn't produce income. So let me start with that because that's the easiest. I didn't make up a special slide for that. All this is, it's functionally like a certificate of deposit, with this, otherwise known as CD. With a CD, it's a product from a bank. You give the bank money, they invest it, and typically you have to commit to a term of 6 months, 1 year, 18 months, 3 years, 5 years, whatever. They will give you a guaranteed rate of interest during that period, a guaranteed rate of annual interest. When that term expires, your CD is up. You can take the money out, put it elsewhere. You can roll into another CD, whatever. But the point is, it earns some fixed rate of interest every year that it's in there. Now, it's not an annuity, so the interest you earn is taxed in the year it accrues, right? So even if you don't take it out, you're still taxed on that interest. Again, annuities, everything is deferred. All the taxability is deferred until you eventually take money out. So multi-year guaranteed annuity, similar to a CD, but you buy it from a bank. Again, it's annuity. All annuities come from a bank. Burn that into your brain. I'm sorry, all annuities come from an insurance company. Burn that into your brain. So a multi-year guaranteed annuity is simply, I go to an insurance company and say, hey, I'll give you this money for 3 years. The insurance company will say, cool, I'll give you, the going rate today is probably 2% a year, maybe 2.5% if you're lucky. I'll give you a fixed 2% per year interest for those 3 years. You're not taxed on it along the way, but each year you are accruing this 2% interest. At the end of the 3rd year, you're done. Contract's over. You can take your ball and go home. You take your $1,000 plus your roughly $600 of interest or whatever it would be, and go home. Or you can put it into another, it's called MYGA, MYGA, multi-year guaranteed annuity. So the good thing is they're higher interest rate than CDs or savings accounts. As I mentioned, a 3-year multi-year guaranteed annuity, 2% maybe now, give or take. You get a 3-year CD at a bank, you'll be lucky if you get 0.6, maybe 0.7%, definitely under 1%. So why the difference? The difference is with the CD at a bank, the only penalty on taking it out early is you forego some or all of the interest you accrued. A bank CD will never make you dip into your principal as a penalty, even if you take it out early. These multi-year guaranteed annuities, very different story. They will make you dip into principal if you take out, I think that you could take out like 10% a year, thereabouts. They will penalize you by not only making you give up interest, but they will eat into your principal and take some of that as a penalty if you take it out early, premature to the contract term, whether it's 1 year, 3 year, 5 years, whatever you choose. There are serious penalties to taking out of a MYGA early. So that's the give and take there. The price you pay for higher interest is you have to be more serious about locking up your money for the term of that contract. And you get compensated for that by higher interest. Whereas a CD, again, lower interest, but you're free to take the money out. You'll lose your interest, but you'll never lose your principal in a CD. So that's a MYGA, a multi-year guaranteed annuity. I will stop there. That's pretty simple. Again, from an insurance company, functionally like a CD, but steeper surrender or early surrender penalties if you take the money out prior to the contract expiring. Done. MYGA. Next, now let's get into the fun stuff. And those don't look and feel like traditional annuities at all. When you all think of annuities, you're probably like, yeah, it's something that was sold to someone and has these expensive bells and whistles and variable account values. No, this is just stripped down. It's basically a CD, and that's all it is in MYGA. But it's technically an annuity. That's why I'm saying it's not fair to use the word annuity to refer to all the stuff we're gonna talk about tonight. Alrighty, next, income annuity. I'm going to start with an immediate income annuity. Very basic features. This is nothing more than you buying yourself a pension. Everyone knows what a pension is. I think everyone would like to have a pension if you don't already. It's simply you get a monthly stream of income for the rest of your life. Done. I think we'd all agree that in principle sounds really, really nice. I'd like to have that. That's in essence what a basic income annuity is. In its purest form, you give over a lump sum of money to an insurance company. They, in return, guarantee to give you, typically it's a monthly payment, a fixed monthly payment for the rest of your life. Whether you die tomorrow or you die in 40 years, that's the payment you'll get. There's different options for payments, but let's start with the most simple. I'm going to walk through immediate now. Immediate is assume you hand the lump sum over today, you start the payments effectively tomorrow. Now, technically, I think immediate annuities, the payments start up to 13 months from when you purchase it. But let's just assume you start it truly immediately. And then deferred annuity just means you give the insurance company money today. You say, don't start my payments till 10 years from now, for example. The insurance company invests that money you gave them. They'll let it grow a little bit. And then in 10 years, they'll then start payments based on that higher amount in 10 years. Now, technically, there are no fees to these. So everyone always says, again, another gross generalization about annuities, they all have high fees. Not technically true. Basic income annuities have no direct explicit fees. Think about a bank account. You go to a bank. Now, sometimes they nickel and dime you with like account charges and check writing fees and whatever. But a basic savings account, for example, there's no outright fees. You put $1,000 into the account. In a year, they'll give you tiddlywinks of interest, and that's it. There's no actual fee. There's no line item of you paying $25. Now, some accounts do have it, but it's very easy to find fee-less basic bank accounts. So in that sense, bank accounts don't have fees, most of them. I think we'd all agree with that. But that doesn't mean the bank isn't making money. They make money by paying you less on your money than what they earn by investing it. So you open a basic checking account today, you'll get 0.01% interest. Well, while your money's in the account, the bank is earning more than that. They're probably earning 0.5% or more on that interest and only paying you 0.01%. So that's how banks make money on the spread between what they pay you and what they get. Income annuities are the same thing. So there's no outright fee. You're not paying like $100 a year in fee. They make money simply by paying you less than what they earn on the use of your money. Clear? So it's true, there are no fees in basic income annuities. So when people say all annuities have fees, not accurate. Doesn't mean the insurance company's not making money, to be clear, but it's true there are no fees in these basic annuities. Let's look at an example here. So this is something called a single premium immediate annuity, or otherwise known as SPIA or SPIA. Single premium means I'm making just one lump sum purchase, one single premium amount, and immediate annuity, meaning the income is starting immediately. So SPIA, single premium immediate annuity. Here's an example. I'm assuming single female, age 65, selecting a life payout. I'll explain what that means, but in a nutshell, it's just simply that payment lasts as long as I do. Once I die, it stops. I'm plopping in 100 grand. Now, this is a little dated. I first made this slide like a year ago for another presentation. At the time, this single female could have gotten about $475 a month in payment for the rest of her life, or about $5,700 a year. Today, this is about 20 bucks less, so about $455 from some research I did earlier today. But for example's sake, this is fine enough. So here's just a graph showing what happens with the money. You put this red bar is how much you pay. You pay in $100,000 on day one, and then these little green bars are your annual amounts of income, $5,700 a year for the rest of your life. I just stopped this graph at 90 for the fun of it. So now you may be wondering, is this a good bet or not? Well, maybe it is, maybe it isn't. These blue bars now show the cumulative cash you've paid and or received. So in the early years, you're $100,000 in the hole because that was your initial buy-in. But then every year you're getting $5,700 from the insurance company. So year by year, these blue bars, your cumulative money paid or received, starts to be less and less and less negative up until the time you're about early 80s, and then boom, then it's then you're money good. You're playing with the house money at that point. The insurance company keeps paying you for life, so you've net received more than you paid in. Now, for you financial nerds out there, this isn't factoring in any kind of time value of money or interest. This is just purely simply adding up cash flows. So, this isn't an entirely accurate numbers, but just to paint the picture, this is accurate. So in this case, you may be thinking, well, that's a sucker bet. What if I die at 68 right here? I paid $100,000. I only got 3 annual payments of $5,700. That's terrible. And in hindsight, yes, that wouldn't have been good. But what if you live to 90? Well, guess what? This was pretty smart then. If you want to view it as a break even, just simply look where the cumulative dollars paid or received go from being negative, they cross over zero and start being positive. That's about age 82 in this example. So all else equal, if you buy this SPIA, single premium immediate annuity, and you make it to age 82, you won. You're now, the insurance company is paying you more than you paid them. If you die early, you lost, the insurance company. Good for them. So just briefly about that, insurance companies don't write just one single annuity. They'll sell you this annuity, and they'll sell the same type of annuity to hundreds, if not thousands of other people. So there's a big pool of people who bought this annuity. There's going to be people who die the next day. There's going to be people who live well into their 90s, if not hundreds. Statistically, the law of large numbers and averages and all this data insurance companies have, they know of this pool of 1,000 people, yes, there's going to be some outliers who die young and get skunked. There's going to be some who live really long and beat the insurance company, but it's going to average out such that the average age of death, if you will, in this pool of people is like early 80s, such that the insurance company is right around break even, hopefully making a little bit as a big pool. So that's how annuities work. For every person that dies young and loses, if you will, all that money they paid in stays in the pot and goes to effectively pay the people that live long and beat the insurance company. So they sort of wash each other out. It's something called mortality credits. Those that die early, the rest of the people still surviving get the benefit of all the premiums that the person who died early paid. Sounds dirty, but it's the math. It's the science of how insurance products work. Okay. So that is the basic immediate income annuity. Let's now look at, here's some options. So remember I said you plop down this lump sum. If you die tomorrow, that was a horrible bet in hindsight. If you live really long, good for you. Logically, a lot of people don't like the idea of if I die tomorrow, all this money was for nothing. Valid point. So insurance companies have a few different payment options you can choose. One is life. That's what I just discussed. The payment lasts as long as you do. It dies once you die. There's joint life. This is only for married folk. If you are married, you can have the payment last until you die. And then when you die, the payment survives on for your spouse. Maybe you can select 100% of the payment survives on for your spouse, or only half, or only 75%, or whatever. But the point is, when you go, your spouse will still get something. That's called joint life. Life with cash refund. Now we're starting to get a little technical. Basically, payments last until you die. And if you do die before you receive less payments in total than what you paid in, you will get a refund for the remainder. So for example, you put $100,000 in, you die the next day, let's say, you get nothing out of it, the insurance company will pay $100,000 to your beneficiaries as the refund, if you will. And if you live long enough such that you burn through your whole $100,000 and you're now playing with house money, good for you. If and when you die, there's no refund because you already won. So, when you stop, the payments stop. There's no payout to your heirs, if you will. Okay. Period certain. This just simply says the payments will last for 10 years or 20 years or 5 years, whatever you choose. No more, no less. If you die before that period ends, the payments continue on to whoever you designate as a beneficiary. If you live beyond the 20 years, tough luck. Your payments stop at the 20-year mark or 10-year mark or whatever you choose. And finally, let's get fancy. Life payout with a period certain. This is simply a combination of life and period certain. So let's assume you pick a 10-year period certain with life, or life with period certain, I should say. If you die prior to 10 years, the payments will last up until the 10-year mark. If you live past 10 years, the payments then stop when you stop. So you get the minimum of the period certain or the remainder of your life, whatever is longer is how long your payments last for. So that's the basic payment options of annuities. And there's other tweaks and things, but these are the big ones that you can typically choose. Let's now look at a deferred income. Same example as before. Single female, age 65, selects a life payout. Payments stop when she stops. Plops in $100,000 day one. This time, instead of immediately starting payments, she is deferring payments for 10 years. They will not start until she's 75. Now, when she does start the payments, they're going to logically be higher because there'll be 10 less years of payments because she delayed the start, and she's going to be older when she does start. So the fact that she'll be older means she's going to statistically live less than if she started earlier. So the insurance company is going to pay her more because they're banking on her not having as many payments as if she had started sooner. So the example I ran about a year ago again would be this monthly payment would be about $925 when she does start at 75, or about $11,100 a year for the rest of her life. So here you see initially the big fat outlay. She plops down $100,000, no cash flows. She gets no money for 10 years. Then boom, in the 10th year, her little over $11,000 a year payments start, and they last for the rest of her life. If you die tomorrow, really bad. If you die any point in the first 10 years, well, guess what? You get nothing. Assuming you took the life payout, right? You get nothing. That's the gamble you take. And then you can see, you're negative. Then finally, once you start receiving payments, then you become less negative in your total cash outlay. And then at some point, you cross over the zero mark. And now, again, you're playing with house money. Every payment you get is, you beat the insurance company. So the break even here is approximately 83. The spot where these blue lines cross over zero is about 83, whereas it was 82 with the single premium annuity. And that's simply just because this has started that much later. Let's see, is that all I'd say about it? Yeah. So I'll leave it there. Is one of these better than the other? It's tough to say, honestly. So if you think you're going to live a longer time, if you have a lot of longevity on your side, this deferred one would end up almost certainly being better for you if you're going to live, well into your 90s. If you weren't going to live into your 90s, then a different story. Now, honestly, the insurance companies are really, really good about handicapping when you're supposed to die on average. If you're an average person, you're not going to beat the insurance company. They got the stuff down pat. If you know something they don't, like, I don't know, you have tremendously long family history and they somehow didn't find out about that when they did the underwriting for this annuity, then yeah, you may be in a good position where you're going to live longer and you may do better in one of these things. But for the most part, these pools, remember, they sell these annuities to hundreds or thousands of people at a time. They don't get these things very wrong, insurance companies. They have decades of experience of pricing and statistically quantifying when this pool of people is going to die on average. All right, so that is income annuities. Just give me a second here, take a drink. All right, let's move on. This is now where things get fun. Indexed annuities, otherwise known as fixed indexed annuities, formerly known as equity indexed annuities. Quick backstory. Let me jump here, and then I'll tell the backstory. So these things are very, very different than the income annuity we just talked about. The income annuity we just saw, basically just a pension. I think we all understand what a pension is, how it works, fixed amount of money for life, pretty clean and simple. Income annuities aren't inherently bad. You don't buy them for massive amounts of growth. No, if in a pure return sense, the percentage return on an annuity typically isn't great unless you live well into your 90s or 100 plus. You buy them for certainty, for guarantee, for stability, for peace of mind, for longevity insurance, meaning if you do live really long, you can't outlive the annuity. It's going to last as long as you do. So you cannot compare an annuity like we just looked at to an investment. It's not. It's apples to refrigerators. It's just so fundamentally different. Now, it's human nature to want to compare it and do a break even and do, well, what's the return of this? And I get it, but you just can't. It's not an investment. It's an insurance product. It's longevity insurance. It's a guarantee. It's a commitment. It's stability. And there's value to that. That's the value. The value isn't monster returns. The value is surety, peace of mind. You know what you're going to get when you're going to get it, like clockwork. Index annuities, they start to get funky. The index annuities are deferred in that you put money in today and it grows by some methodology. You don't get any income out immediately, typically at least, or rarely do you. You put it in, you let it grow. Now, what's unique about indexed annuities is the growth you get each year is based on some predefined, what's called crediting method. Crediting just simply means how they calculate how much interest, how much growth they give you. The crediting is indexed off of some major market index, typically like the S&P 500. To be clear, you are not invested in the S&P 500. You do not get returns anything close to those of the S&P 500. You just simply have this custom little sort of side bet with the insurance company where they say, if the index goes up this much, we're going to give you, this much instead. So it's your return in this is based off of, it references an equity index like the S&P 500, but you are not invested in it. You do not get the index returns. Let's be clear, and I'll explain what I mean by that. The big draw of and the big selling point of index annuities is your contract value. So long as you touch it, you don't touch it. You let it sit there and do what it's supposed to do. It will not go down. No matter what the index does, if the index drops 20% in a year, the S&P drops, your account value will not go down. It'll only go up. Not by nearly as much as the S&P, but it will only go up. It will not go down. Again, assuming you play by the rules and you don't take it out early, you just let your money sit there and stay for the life of the contract. Now, the contracts could be 3 years, 5 years, 7 years, 10 years. It all depends. These things are highly customizable. Now, so you let the money sit there for, let's assume it's a 10-year contract. You let it sit there. It's going to maybe go up a little bit each year, or it'll do nothing. Again, it will not go down any given year, unless you have penalties or whatever because you take it out early. But again, assume you keep it in there and let it bake for the full 10 years in this case. At the end of the 10th year, now how do you get your money out? At the end of the 10th year, at that point, you're free and clear. You can take your money and walk. You have to pay tax on any gains if you did not buy it inside an IRA. If you bought it inside an IRA, it's all taxable when you take it out, just like any IRA investment is. It's completely taxable when it comes out. Otherwise, you buy it outside an IRA, you only pay tax on the gains, above and beyond what you put in. So at the end of the contract, you can take it out. You can keep it there and let it stay crediting, getting some sort of interest each year, or you can annuitize it. Annuitize means simply turn it into a pension, turn it into an income annuity. You take your contract value in this index annuity, you hand it over to the insurance company, be like, just give me income for life, give me a pension. That's what annuitize it means. When you annuitize, it's usually irrevocable. Once you do it, you can't take it back. You gave the money over to the insurance company. You no longer own it. Instead, they're just going to pay you for life, with a monthly payment. Now, this is where these things get further confusing. Is you can also purchase additional bells and whistles. In the insurance industry, bells and whistles are called riders. That's all that means. An extra option you pay to have. You can buy riders to give you some sort of minimum level of withdrawal. Now, not income. You're not annuitizing it. Again, annuitizing is you irrevocably hand the money over to the insurance company. They agree to give you monthly payments for the rest of your life. That's annuitizing. A withdrawal rider is simply you don't hand over the money completely, but you buy an additional guarantee to say, I will be able to withdraw whatever, $5,000 a year for the rest of my life. That's an additional rider you can buy, a withdrawal rider. Again, indexed annuities, like income annuities, technically no fees, most of them. The basic index annuity without any extra riders, if you play by the contract rules and let the money sit in there for the full contract life, there are no fees. So it's not a lie when annuity salespeople say index annuities have no fees. Technically true. Again, it doesn't mean the insurance company's not making money. They are. They're paying you less on your money than what they earn by investing it, and that's completely fair. They should make money, just like banks. They need to be profitable, otherwise they wouldn't exist. So there are technically no fees in the basic index annuity. Now, if you buy a rider, this extra guarantee to withdraw a certain amount, that costs money. That's typically, upwards of about 1% a year. Could be more, could be less, but figure about 1% per year. That's an outright fee you have to pay for that rider. If you early withdraw, I see Cody asking about rates and caps. Cody, you are going to love the next slide. I'm getting ahead of myself. If you early withdraw, then there's penalties and fees. But like I said, if you just play by the contract rules, and don't take your money out prematurely, there are usually no fees to most index annuities. That is true. All right, so let's now talk about crediting. This is where index annuities get funky, and I have an example to show. So let's use the S&P 500 as the reference index. It goes up, it goes down every year. Index annuities may have a cap rate. It says if the index goes up 10%, we will give you all the return of the index, but we'll cap you at, let's say, 4.5%. Meaning if the index goes up 1%, you'll get 1%. If it goes up 2%, you'll get 2%. If it goes up 10%, you only get 4%. You're capped. That's a cap rate. So that's one crediting method. Next is the participation rate. It says whatever the index goes up, we'll give you a percentage of it. Let's assume your participation rate's 50%. If the S&P goes up 10% in that year, you'll get half of it. Your contract will only go up 5%. If the S&P goes up 1% for the year, your contract will go up 0.5%. That's a participation rate. And again, all these things are subject to a floor of 0. If the index is negative for the year, you won't get anything, but you're not going to lose anything either. It's floored at 0. Next is a spread. A spread is however much interest they'd otherwise credit you, they're going to shave a certain amount off the top, let's say 2%. So if you're supposed to get 6% based on your cap rate or participation rate, and your spread is 2%, they're going to slice 2% off such that your 6% is now 4% interest for the year. And finally, there could be bonuses. These are basically just these little kickers and incentives they'll throw in, like, hey, keep your money in here. We'll throw you some extra money up front or some extra interest. Let's now see an example and bring this beast to life. Here's a basic indexed annuity. I'll call it option A. You put in $100,000. And this is an actual contract. I don't remember which one I looked at, but I did, when I put this together, better part of a year ago, I did find a live, able to be purchased contract at the time. So these are all real numbers as of a year ago. $100,000 purchase, 10-year contract. It's indexed to the S&P price change for the year. I won't get into the details there. There's different ways to measure S&P, but typically these index products go off price change, not total return, for what it's worth. This particular one has a 100% participation rate. So for every 1% the S&P goes up, you get 1%, but subject to a 4.5% cap rate, meaning you'll never get more than 4.5% interest per year. There's no spread, so they're not shaving any additional amounts off your interest, and interest is applied annually. So let's look at how this would work. So these were actual returns of the S&P from 10 years, from 2010 to 2019. Again, I did this presentation like a year ago, which is why 2020 returns aren't in here. So the blue bars are the S&P's return in each of those years. And yes, it did return 0 in 2011. It was like 0.00 something. So you can see most years the S&P was up, flat, up a lot, up, down a little, up, down, a pretty good amount, up a lot. This orange bar is the interest or return you got in your indexed annuity. So 100% participation, meaning for every amount the S&P goes up, yours goes up the same, but capped at 4.5%. So you can see here, anytime the S&P's return was more than 4.5, your contract only got 4.5% return for the year. In years where the S&P was 0 or down, your contract got nothing. Like here, S&P was down, you lost nothing. S&P was down, you lost nothing. But all these really big good years, you only got 4.5% interest. And that's why I'm saying you are not invested in the market. This is not an investment. This is just a side bet you have with the insurance company where your returns are indexed off of some index, but you're not actually invested in the index. So let's now look at what would have happened hypothetically if you put $100,000 into this annuity. At the end of 10 years, it would have grown to $136,000 or an annual return of about 3% per year. Had you been actually invested in the S&P 500, your $100,000 would have grown to $289,000 or an average return of about 8.15% per year. This is common. Never, ever, ever expect an indexed return that's based off the S&P is going to return anything close to what the S&P does. They're just functionally, structurally not set up to do that. Because of these caps, because of these spreads, because of participation rates, you're going to get low to mid single digit returns at best. If you get more than that, great, but don't anticipate it. With that said, these aren't necessarily bad products or investments. You just have to be crystal clear about your expectation about what you may potentially earn. Yes, your downside is limited to zero, assuming you don't take it out prematurely or pay for extra bells and whistles. But your upside is going to be severely hampered compared to what the actual index is. But that's fine. That's how it's intended to be used. Now, where these products and the companies have gotten into some trouble is how they used to market it and pitch it and kind of tell half-truths about it, which is why the name used to be equity indexed annuities. I think the insurance industry got in trouble for saying that because it was kind of misleading to people, thinking they're either invested in actual equities or going to get equity-like returns. Well, guess what? They're not. They're getting a few percent per year. So they had to change the name. Now it's fixed index annuities because your returns are fixed to some index. So anyway, so these aren't deceptive or bad products. You just have to fully understand what they do. The problem is they're so complicated. Most people are not going to fully understand what they do. And it's not because you're thick. It's just these are really complex products. If you've ever seen an annuity contract, it's dozens of pages of fine print and lots of legalese. It is not easy to digest. All right, so this is the option A index annuity. Again, 100% participation, 4.5% cap rate. Next example, option B. Similarly, 100,000 grand you put in. It's also a 10-year contract, also indexed to the S&P. Difference is now, instead of 100% participation up to a 4.5% cap, now you're only getting a 60% participation of the S&P. Furthermore, that return is sliced off. They take 2% off the top for a 2% spread. There's no cap. So in theory, you have unlimited gains you can make in a given year. And again, interest is credited annually. Let's look at this. So again, these blue bars, exact like before, these were the S&P's returns each of these 10 years. Get a drink here. The orange bars are what this option B indexed annuity would have earned for you each year. So 60% participation rate, again, whatever the S&P, you're protected against the downside. So any 0 or negative years for the S&P, you don't lose anything. You don't gain anything, but you don't lose anything. On the upside, you get 60% of whatever the S&P got minus 2% because of the 2% spread. So follow me. So this is, I don't know what this is. This is 13%, let's say. So you got, that's a bad number. What's 60% of 13? I don't know, whatever. It's going to be, let's call it 7%. It's probably close enough. 8% maybe. So 60% participation means you would have gotten an 8% return, but shave off your 2% spread. That means you walk away with 6% return this year. And then do that same calculation every year. You get 60% of the upside minus 2%. That's your contract's return for that year. What would that have looked like over 10 years? Your $100,000 would have grown to 178 grand, or about 6% per year on average. Pretty good. Versus again, the S&P would have grown by about 8% per year. So two different options. Again, this was a live contract you could have purchased this time last year when I was looking at it. In hindsight, option B obviously was better. But what if the S&P returns were much more muted over this time? Then you would have been better with the 4.5% cap option as opposed to this. With years of higher returns, this one does better. Years of lower returns, the other option would have been better. So, it's impossible to say which one is better. Only hindsight will be able to tell you that answer. But the important thing is understand how it works and know what you're buying. All right, where are we at here? 841. Yeah, let me keep going. So how do you get your money out? So I said this is a deferral. This contract was 10 years. The expectation is you keep the money in there for 10 years. How do you get your money out? Well, in each of those 10 years, you're allowed to take out up to 10% of your contract without penalty. That's a partial withdrawal. Then there's excess withdrawals. If you take out anything more than 10% per year, you can, but you're going to have a surrender charge. And these surrender charges are really large up front, and they sort of tail off over time. So in year one, if you take out more than 10%, more than your partial withdrawal, you will have to pay a 9% penalty on the amount you take out. Same thing in year two, year three, year four, they tail off. And then eventually after 10 years, there's no longer any withdrawal surrender penalties such that you can take out the entire contract at that point, no penalties. Now, fun fact, why do annuities have these surrender charges? Well, partly because it's part of the price you pay for the insurance company giving you some sort of guarantee, promising you some kind of return. They want and need you to lock up their money so they can invest it for the long term without fear or risk of you turning around and like taking it all out real quick. Or if you do, at least you're going to pay a penalty, and that's how they get compensated for it. But the other big part of this, maybe you know, maybe you don't, is because of the commissions paid on annuities. So most, if not all, I think all annuities have some sort of commission tied to it for the person who sold it. Now, the more complex the annuity, the higher the commission. Commissions can be anywhere from 2 to 3% upwards to like 10% of the annuity value. So in this example, if you put in $100,000 into this annuity and it paid a 10% commission, the person who sold it to you will get 10 grand up front. They get a check for 10 grand. That's their commission. That's their compensation. These surrender charges are partly to reimburse the insurance company for if you do take your money and leave early, where they're left on the hook because they paid the commission to the person who sold it. So if you walk away tomorrow, the insurance company's skunked. So they're going to slap you and basically make you reimburse them for the commission they paid the salesperson. I think it's important to know how that works. There are some annuities you can buy through fee-only people that don't have these surrender charges. Not a coincidence. That's because there's no commission associated with it. So anyway, so that's a large reason why there's surrender charges, because it's you have to reimburse the insurance company for the commission they paid the salesperson if you leave early and you're not in the contract long enough for them to make enough money off of the contract to for them to reimburse themselves for the commission they paid. This is getting kind of technical. There's some other withdrawal features I mentioned before. An income rider. This is an extra option you can buy to give yourself the ability to make guaranteed withdrawals for the rest of your life starting at some point. Or you can just straight up annuitize it. And again, annuitization means you irrevocably hand over your contract value to the insurance company in exchange for them agreeing to give you monthly payments for the rest of your life. All right, so let me move on. I think that's it. And variable annuities, this is the next main. I'm just looking at comments here briefly. Quick side note. You have to really pay attention to how these crediting are structured. I just saw an annuity, real life living, breathing annuity from someone just a week ago. Index annuity referenced off the S&P 500. The calculation method for crediting is based on a monthly basis. The contract earns interest once a year, but based on monthly looks. During 2020, I think it went February to February. It was a contract period, so it just passed. The S&P was up, I'm making this up, 20% over that time. Something relatively large. I forget the exact number. So the S&P was up like 20%. The contract made zero for the year. Because of the way the calculation was structured, it looked at every month's return. Every monthly gain was capped at 1.25%. Every monthly loss was uncapped. It can be whatever it was. So during the course of the year, there's a really bad 20% loss in March of last year. And some other months were good, but those other months were capped at 1.25. So when it came time to do the annual interest calculation, it simply summed up all these monthly amounts. And that 20% monthly loss completely outweighed all the little monthly gains she had because of the cap, such that for the year, her contract got 0, even though the S&P was up like 20%. So you have to be real clear how these calculations work, and don't be surprised when a calculation like that happens and you get nothing when the S&P had a monstrously good year, because that's how the contract is structured. Now, it's not dirty, it's not illegal. It's partly buyer beware. You have to know what you're getting into, and it is partly the industry's fault for not being as outright or forthcoming with their projections and their estimates, and not telling the whole gory truth of what may happen. You'll see the shiny, slick presentation showing you the good that could happen, and the potential downside or drawbacks will be in the fine print that you have to dig through and see. So anyway, I thought that was an interesting story, very timely because of this presentation tonight. So variable annuities. Similar to index annuities, these are deferred. You put money in, you get some sort of interest over the years, and then eventually you do something with that money. Now, the big difference between variable and index, again, indexed could not go down, would only go up, but by some relatively small amounts. With the variable annuity, the money is actually invested in real investments, stocks, bonds, mutual funds, whatever. So the account value can go up and very much can go down. Whatever you're invested in, that's what your contract's going to do. It can be negative. Just like an index annuity, a variable annuity has a term, let's assume 10 years. At the end of that contract term, there's penalties to take money out prematurely. At the end of the term, you can take your ball and go home. You could keep it invested, or you could annuitize it, whatever. You can also similarly buy a rider, a guaranteed withdrawal rider, like you can with the index annuity. Unlike income and index annuity, there very much are explicit line item fees, clear as day. Here you go, and I'll explain. I'll walk through what the typical fees are. So yes, variable annuities do very much have fees. Income annuities do not. Most index annuities do not. It is accurate and true to say that, unless again you early surrender or you buy a rider or something like that. So the fact that your contract can go down, this begs the question: what happens if I die the next day? Then what? Well, typically they will give a guaranteed death benefit. Usually it's keyed off of the amount you initially put in. So like in this example, you buy a contract today for $100,000. Your investments don't do well. Over three years, it drops to $80,000. Well, if you die then, the insurance company typically guarantees, okay, we'll give your heirs back $100,000. We're not going to leave you with just 80 grand. So there's an insurance component built into variable annuities, which kind of complicates it because it's part investment, part insurance, as you can see. And this insurance isn't free. You pay for it, and that's part of the fee. And I'll touch on that more in a bit. So withdrawal features, functionally just like index annuity. Again, if you take money out prematurely before the contract's over, you can typically take out up to 10% per year, no more. If you take out more than that, there's a surrender charge. You can buy an income rider just like you can with index annuities, or you can choose to eventually annuitize it. Again, that just means irrevocably hand the money over in return for a lifetime stream of payments. Here's the fees. So typical fees in a variable annuity: one is the administrative fee. It simply pays the insurer's cost in operating the separate account. The separate accounts are the investments you're actually invested in. There's process and paperwork and people involved in managing that. So that's the administrative fee. All the contractual work, processing the payments to be sent out to you. Because these are technically invested, these are considered securities. They're under the regulation of the SEC. There's additional regulatory reporting that comes along with it. Income and index annuities are not securities because they're not actually invested in anything. So there's no SEC oversight of those like there is with variable annuities. Mortality and expense charges. Like I mentioned before, the idea of mortality credits for those that die early in an annuity, their money stays in the pool to pay people who live long. The insurance company takes on risk with running these pools, and they pass some of that risk through to you by way of mortality and expense fee. Some also have some nominal flat fee, $25, $50 a year. Typically, it's waived if you put more than a certain amount into the contract. Surrender fee we touched on before. You take the money out prematurely, they'll slap you with a penalty. And then the expense ratio. So again, variable annuities are actually invested in pools of investments. Just like mutual funds, there's costs associated with running those pools. There's an annual expense that comes out of those investments. You have to pay those expense ratios too. as part of investing in these investments through your variable annuity. If you buy optional things like riders, you buy an income rider, you'll pay extra for that. You can buy additional death benefit. There's some features where the death benefit will like step up over time and won't be just your initial purchase. You can do that, but guess what? Comes at a cost. So you can see how these fees can start to rack up. Let's look at an example. This was another real example of a living, breathing variable annuity I looked at about a year ago. This one with no special bells or whistles or riders. $100,000 purchase, only a 5-year contract. You choose to invest in a balanced fund that's roughly 60% stocks, 40% bonds. The expense ratio of that fund is 0.92. So pretty high, right? You can find any good mutual fund with an expense ratio well below 1%. 0.5% give or take is reasonable for actively managed. Anything passive, it should be 0.10% or under. So relatively high expenses of the investments themselves. Then there's the contracts expenses, the administrative fee, 0.25% per year, the mortality and expense fee, 0.95%. And then a $50 annual fee, but that's waived if the contract's over $50,000. So right off the bat, add this up. You're at little over 2% fees for this variable annuity every year. These are real fees, right? This eats into the value of your contract. But again, keep in mind you have some death benefit. So like there's you're getting something for it. It's not that you're completely just handing away money. But still, the fees aren't cheap nonetheless. Let's look at what would have happened. So over 10 years, the gray bars, if you were to invest in just the mutual fund itself, your $100,000 would have grown to about $203,000. Your investment inside the variable annuity, you invested in that same mutual fund, but now wrapped inside this variable annuity would have only grown to about $180,000. Why is that? The fees. You're paying that additional 0.95% mortality and expense, the additional 0.25% administrative fee. Fees matter. Look over time, right? Your difference of your return relative to the fund itself keeps getting larger and larger and larger because the fees keep chiseling away at it. Let's now look at what happens if you bought a rider. Riders can be complex. That should be its own topic. But sorry, as I was putting this together, I realized, man, I'm jamming in a lot tonight. Anyway, so same annuity, but this time you're buying a rider. Now, a rider is just simply they're guaranteeing you at some point in the future you'll be able to pull out at least X amount of dollars per month, or actually, precisely X amount of dollars per month the rest of your life. So we're adding that in. And there's a fee for that rider. In this particular annuity, it was an additional 1.8% annual fee to buy this rider. So now add it up. You got your 0.92% expense ratio of your fund. You got your 0.95 mortality and expense. You got your 0.25% administrative fee. So we're at 2% and a little. Add to it another 1.8 in rider charges. You're at upwards of 4% annual fees. This is not uncommon in variable annuities. And this is why people say annuities are terrible, have high fees. You're thinking of this. Yes, this particular structure of annuity has high fees. The other ones we discussed, technically no fees. So that's why I just want to make clear, again, I don't sell annuities. I don't want to sound like I'm defending them at all costs, but it's a bad rap to say all annuities are garbage, all annuities have high fees. This one does. The other ones we looked at technically have no fees year to year. Let's look at this. So now, this is where things get funky. So these orange bars, this is your annuities contract value. What's this blue bar? Well, this is what a rider does. You have your actual contract value goes up and goes down based on how it's invested. When you buy a rider, there's a separate fake phantom hypothetical accounting of contract value. It goes up every year by 7% per the terms of the rider. And this is where annuity sales get a little greasy. They'll say you're guaranteed 7% growth every year, sort of. And I'll explain what I mean. So your actual contract value goes up and goes down. It's these orange bars. Your guaranteed benefit base, this phantom contract value, goes up a fixed 7% per year. Ding, 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 ding. So it's going up to over 140 grand over the course of 5 years. What does this mean? Well, with this rider, the benefit base, this phantom contract value, will grow 7% per year. And then at that point, you can start withdrawing 5% per year for life from that phantom base. Let's walk through that. Super confusing, I know. So in the first 5 years, that's what's called the accumulation phase. Your contract value does what it does based on the investments it's actually invested in. Your phantom benefit base goes up a fixed 7% per year. And then you hit the payout phase. Then you turn on your rider. Then, so this phantom base grew to $143,000 and change. That's the blue bars. Your rider says you can withdraw 5% of that every year for the rest of your life, which means do the math. This times 5% means you can withdraw over $7,000 per year from your contract for the rest of your life. At that point, going forward, this blue phantom benefit base has zero meaning. It's not the amount of money you can walk away with if you close the contract. It's important to be super clear on that, right? And that's why I say when the insurance salespeople say, well, you're getting a guaranteed 7% growth per year, your phantom income base is, you're not actually getting something that's growing 7% that you can then walk away with after realizing that growth. No. The amount you can walk away with any given year are these orange bars. This is your contract value. Completely disregard these blue phantom benefit-based bars. That's not what you can walk away with. That's used solely to calculate the amount of income you can withdraw under your rider. I know, I dumped a lot on you there, a little confusing. But anyway, so now fast forward to 2021. So this, this thing was bought in 2010. The $143,500 phantom base, that's not your money. You can't walk away with that. If you liquidate this contract today and walk away, you walk away with $100,000. If you keep the contract, as it is, and you keep pulling out your $7,000 a year, your contract's going to keep dwindling. Eventually, it'll hit zero if you live long enough. And this is the benefit of these riders. If and when the contract value hits zero, you can still continue getting $7,000 a year from the insurance company. So now you're playing with house money. So that's the real draw of these riders. If and when you think you're going to have a need for income and or may live long, that's when these riders start to make some sense. All right. That's all I got on that final comment. Insurance company. So remember, all these things are just contracts you have with an insurance company. They're only as good as the insurance company's claims paying ability, otherwise known as its willingness and ability to pay you when they're supposed to. You're buying something that's potentially a 30, 40, 50-year commitment from the insurance company. You want to make sure the insurance company is going to be around. There's a company called AM Best that does independent ratings of insurance companies. Basically, this is their rating scale. Where I'm going with this is you only want to buy annuities from insurers who are somewhere in this A category. Do not bother buying annuities from these. They're weaker credit. They may not be around, to make good on your claims. They will offer you higher benefits and payouts and options to entice you to get their business because they have to. Because they're trying to compete with the big boys that are better rated. They need to hit you with some gimmicks or make some promises they may not be able to keep. So anyway, so don't buy insurance from anyone rated below A. For those of you who watched the long-term care insurance presentation last week, exact same comment came from Carrie Peabody about long-term care. Only buy from insurers that are in this A-rated category because those are the ones most likely to actually be there when you need them, whereas these ones are all, higher risk. Whew. All right. That is it for annuities. I will take the screen share off. Again, after going through this, I realized I should have broken this up into 3 different sections. All right. Let me do my best about questions after getting some drink here. Oh, and if you didn't notice, where am I? Look at this. Custom message board. Facebook Live Wednesdays. Annuities. Now, I just kind of basically commit myself to have to update this once a week to make it reflect whatever topic I'm talking about. Anyway, okay, so questions starting at the top. Here goes nothing. Let's see. What do we have? Facebook user, what is your opinion of MYGAs, multi-year guaranteed annuities, as a replacement for CDs in this low yield environment? Yes. They're better than CDs in that the interest rate is higher. That's the upside. The downside is, again, much stricter requirements to actually keep the money in there for the full length of the contract. If you are willing and able to actually, to buy a 3-year MYGA, for example, and you're not going to need to touch it for 3 years, then sure, then you will get better interest than a CD, in which case it's a better product. But again, you have to pay close attention to the early surrender penalty, because that is meaningful if you do have to break the contract. David Fultz, why are there no insurance companies that sell inflation-adjusted annuities? Because they would lose their shirts. It's just way too risky. There used to be annuities where you can buy inflation adjustments. So now, everything I showed now, once you annuitize it, once you get your payments, it's that payment for life, right? $2,000 a month today may sound pretty good, but it'll still be $2,000 a month in 30 years from now, which may not be so great. It's just too hard to try to guess what inflation is going to be. It's too much risk and unknown for the insurance companies to take on. Or if they did, it would be so cost prohibitive to you, the annuity buyer, that your payment today is going to be so low to make up for what if it grows a lot because of inflation. I believe that no insurers offer inflation adjustments anymore to annuities, Dave Fultz. There used to be some, but someone in the industry told me about a year ago that no more do because it's simply too risky. In what circumstances would it be a good strategy to purchase an annuity with a Roth IRA for steady stream of guaranteed income that's tax-free? Heard someone discussing this and seemed like a good strategy, but was inconsistent with other discussions about having Roth have the most aggressive of one investments. Yes. So that second part of your question is generally accurate. You typically would want your Roth to be the highest growth potential stuff, because all that growth will be tax-free, as opposed to if that growth was in an IRA, it's all going to be fully taxable when you take it out. Now, yes, if you buy an annuity in a Roth, all the money will be tax-free. But again, there's no single right answer, but you may want to consider saving the Roth for the higher growth stuff, for the tax kind of savings reasons we mentioned before, and put the safety, security, stability of the IRA in of an annuity in an IRA, where steady eddy returns. You know what the payments are going to be. Now, if you're in a position where Roth money is the only money you have, good for you, first of all. But if that's the only money you have and you want or need an annuity, then you simply don't have an option. You got nowhere else to put it but the Roth. But otherwise, I would think not the best use of a Roth. Not saying it's the worst, not saying there aren't cases where it may make sense, but generally speaking, I don't know how that could be optimal majority of the times. What were MYGA rates a few years ago when CD rates were paying 3% or more? I don't know, honestly. I last looked a few months ago and they were actually more than that. It was like close to a year ago. I don't know. I don't remember. They were 2.5 or 3. So yes, they should have been higher than what CD rates were at the time. I don't know what they were, though. Good question. Yep. There you go. What else do we got? Do the annuity payout options cost more money? Yes. So anything, there's no free lunch with any of this. Anything that gives you more benefit than what you otherwise have, you're going to pay for it. So the largest payment you can choose is the life payout option, which means as soon as you die, the payment stops. That'll be the largest. Once you start putting a spousal benefit, joint life on it, the payment's going to be lower, because now you have the added benefit of, if you die early, the payment lives on for your spouse. If you want a refund option, it's going to be higher and things like that. So no, there's no free lunch, and all those other extra features will cost you more in terms of you'll get a lower payment for it. Yeah. Okay. So someone responded to that. And I see Cody responded to that as well. Good. David Fultz. It's projected that a baby born today will have a life expectancy of age 100. How will this affect annuities of the future? Yeah, to be seen. All else equal, David Fultz. So every so often, I don't know, 10 years, 15 years, insurance industry redoes mortality tables. They look at census data, they look at how long people are actually living currently, and they will revise their statistical analysis of how long people are anticipated to last. So over time, as life expectancy actually ticks up, insurance companies will incorporate that into their annuities. All else equal, the longer someone's expected to live, the lower their payments are going to be under an annuity. That's the simple answer to how things will be impacted. Yes, will you be able to view this later? Yes, all these videos are saved to my YouTube channel, Retirement Planning Demystified, and also save the link to that video in this group the next day. Love your post, thank you. But when would buying an annuity ever be a good quote unquote investment compared to high interest savings accounts, high yield bonds, or brokerage accounts? What am I missing here? You can't compare them. They're not traditional investments. The variable annuity does actually invest in traditional investments, but it's wrapped with all kinds of other features like the minimum death benefit, like typically some kind of rider, like the ability to annuitize it down the road. All those things come at a cost, so there's going to be fees associated with it. So if you're looking for a pure investment, a variable annuity will never compete with an actual investment-only investment because it's saddled with these fees because it has these extra features and bells and whistles. So you can never compare an annuity to an investment. It's not a fair comparison. If you want an investment, buy an investment. The downside with investments is there's no guarantees, there's no floors unless you buy like a CD, which isn't really an investment, it's just a bank product. Any traditional stock, bond, mutual fund, there's no guarantee. With these insurance products, there's always some sort of guarantee behind it, whether it's no loss in the case of an index annuity, whether it's a variable annuity with a minimum death benefit. So you cannot compare. It's just simply not fair. If you want an investment, buy an investment. If you need guaranteed income, that's when you start considering an annuity, not because spectacular growth. You buy it for income, you buy it for some death benefit perhaps, you buy it for the features and guarantees specific to an insurance product that an investment product simply can't have for you. So that's what it is. So, and that's why people who say annuities got horrible returns, well, yeah, they're supposed to. They're not investments. They're guarantees. They offer something that you can't get from an investment. Anyway, long-winded answer to that question, but it's just simply not an apples-to-apples comparison because they're not investments. Cody, thank you, Cody. So here's the question about the archiving and all my other videos. Yeah, Renell. So this gets back to what I just said. Is it better to just invest in the S&P versus an annuity? Impossible to say. It depends what your purpose and intention and need is. If you want and or need guaranteed, stable, secure lifetime income, investing in the S&P is not the answer for you. An annuity is what you want to start considering. If you already have or Social Security or pension or whatever, and you have no need for additional guaranteed income, then sure, then start considering traditional investments like a stock investment, like a bond investment. It really all depends what your goal, what your needs, what your wishes, what your risk tolerance is, what your income needs are. These are all things you have to consider when deciding, do I buy an insurance product like an annuity? Do I buy a traditional investment like a mutual fund or something? Whoever this was, in my example, I don't remember if the S&P values I used were total return or just price return. I may have just did price because the annuity was based on price return, I think, but I don't remember. Okay. Yeah, here we go. A question for the end recap, and we're at the end recap. Government Social Security is kind of like deferred joint inflation adjusted income annuity. Exactly. Social Security is nothing more than an annuity, one that is deferred, meaning you pay into it throughout your life. You don't get anything immediately. Every year you work and pay wages or get wages, you pay tax into Social Security. Its income is deferred to some point in the future, typically 62 at a minimum is when you can get benefits. And then it lasts for life, and it has an inflation adjustment. Honestly, Social Security is the best annuity there is. It's not technically an annuity because it's not from an insurance company, but it's functionally an annuity, and it's the best one out there. So that's why people I work with, one of the main goals is almost always to maximize and get the most out of Social Security because it is such a good annuity. There's only 3 possible ways to get guaranteed, steady, stable, secure lifetime income. 1, Social Security. 2, traditional pension, if you're lucky enough to have one. 3, annuity. So this goes back to why would you ever consider an annuity other than a MYGA? Because a MYGA is basically just a CD, short-term, cash investment thing. Why would you ever consider one of the other annuities? Well, if you want or need stable, secure, guaranteed lifetime income, and you don't have enough through Social Security, you don't have much or any pension, an annuity is your only option to get that stable, secure, guaranteed, last as long as you do income. That's when you start to consider annuities. If you don't have an income need or don't foresee yourself having an income need in the future, you may not want to consider an annuity. The other big exception to that is indexed annuities. Remember, I said their returns should kind of bumble around, low single digit, mid single digit average return over their life. You can sort of view that like a bond-like investment. So if you have a portion of money that you're willing and able to lock up for 5-10 years, whatever your contract term is, an index annuity honestly isn't a bad bond replacement, bond alternative. You're not going to kill it. You're not going to get 20% per year, but you're not going to lose anything either. You'll get, like I said, 3, hopefully 5% per year on average. That's not bad from a bond-like perspective. So that's another time you may consider using that type of annuity as like a bond alternative if, again, you're willing and able to commit your money for the full length of that contract. Otherwise, there are steep early withdrawal penalties. Are you saying there are no commissions on index annuities? I'm not saying that. There are definitely commissions on index annuities. The difference is you, the annuity buyer, you do not directly pay the commission. So this is where it's sort of a half-truth from insurance companies and sales people sell annuities. They'll say, yeah, I get paid a commission, but you don't pay it. The insurance company pays me. It's no cost to you. And that's true on the surface. When you put $100,000 into an annuity, all $100,000 goes to work, if you will. You don't pay the $10,000 that gets paid. You don't directly pay it, that commission to the salesperson. But remember I said that's why the surrender charges are there, largely. If you bail on this annuity prior to riding out the 10-year contract, the insurance company, they get stiffed because they paid that commission up front to the salesperson. And if you're not in that contract long enough for the insurance company to make enough money off of it to recoup the commission they paid, they make you basically pay it by hitting you with that early surrender charge. So no, they have commissions. You don't pay them directly. That's true. But you indirectly pay for it by being stuck with these surrender charges. So that's how these commissions and indirectly you pay them works. My 403B from 20 years ago is an annuity. It's small at 59. Can I cash it out and just pay the tax on it, Brenda? I mean, I can't say without seeing and reading all the details, but generally speaking, a 403B is like a 401k, but often structured as an annuity, or not structured, but is an annuity. Rule of thumb, and this isn't specific to you because I don't know your particular plan here, but rule of thumb is if it's a tax deferred account, which it probably is, once you're 59 and a half, you can withdraw it without penalty, but you will have to pay tax on it. So that's my guess, Brenda. Don't quote me. Definitely ask the plan administrator, your 403B administrator, what the specifics are. But that's likely what the answer is going to be. Okay, what else we got here? Oh, here's a big one. I don't know. Looks like just someone got a improperly sold an annuity here. The comment's so long it kind of cut itself off, so I won't address this. But yes, the industry has. There are really good, honest people in insurance that do want to do right and do right, but there's also not. It's like all walks of life, all industries. There are snakes, there are sharks, there are people who will take advantage of you. It doesn't help that the compensation method for selling this stuff is tied to commission, mostly, if not solely, commission. So when someone's incentivized, their only pay is moving product. It doesn't help tip the scale in terms of those who are unscrupulous to start with. This just makes it worse, the compensation method. But I don't mean this to bash insurance or insurance salespeople. I don't agree with the compensation method. It is what it is, but there are lots of really good, genuine, truly helpful and honest people throughout the industry. But there are cases like this where things just get improperly sold, unfortunately. David Fultz, when purchasing annuities, you recommend keeping purchase at $300,000 for state insurance protection. Yeah, that's a good one. So I honestly don't know unlike investments where the SEC is a national thing and securities dealers where FINRA is a national thing, the insurance industry is regulated state by state. So in every state an insurer or an insurance salesperson operates, regulation and registration and oversight is at that state level. And each state has slightly different rules and regulations. So there are basically state insurance funds. If an insurance company goes belly up, you're not completely lost with all the guarantees it made to you. There is this insurance backing system. I don't know what the limits are, David Folta. I guess you're insinuating it's 300 grand. It could be true. I have no idea. If that's the case, then yeah, maybe. Then maybe you want to spread your annuities around, get no more than the insurance limit from one insurer. And then if you want more annuities, buy it from another insurer, perhaps. Good comment. Yeah, great question. But let me just, in the interest of time, I'll save that. That's really not a annuity question at all. But great question, Renell. Annuities have a role in Medicaid eligibility for long-term care. Do they not? I don't know, honestly. I would assume they do. I mean, if it's a contractual income stream, just like Social Security is, it's never going to go away. I would assume Medicaid would take that into account. I do not know for a fact. Good question, though. Looks like we're almost done. Last comment / question. Did I hear you correctly that if you have Social Security and a pension, then the only annuity that may be worth considering would be variable? Oh, I definitely did not say that. No. So in my mind, there's a great question, by the way. There's basically, let's say, three general instances where it starts to make sense considering an annuity. One is simply the MYGA, which is basically just a CD equivalent, higher interest but stricter early withdrawal penalties. If you have some cash you're looking to park for a few years and you're willing to leave it parked and you want some higher than bank rate interest, then you consider the multi-year guaranteed annuity, otherwise known as MYGA. That's one flavor of annuity. That's case one. Case two, if you ever have a want or a need for stable, secure, lifetime monthly income stream, then above and beyond what you already have, then maybe you start considering an annuity. Again, there's only, and this is where Social Security pension came in. There's only three things that give monthly payments for life: Social Security, traditional pensions, annuities that you annuitize or buy an income rider on. Those are the only three ways you can get stable, secure, guaranteed monthly lifetime income that'll last as long as you do. So let's assume you have total annual expenses, required expenses of $100,000 per year. And your Social Security is only 20 grand and you have a $10,000 pension. So you only have $30,000 of guaranteed income against which you have $100,000 of necessary expenses for the rest of your life, $100,000 per year. Then you may want to start considering, okay, well, if my portfolio were to my traditional investable assets ever deplete, my Social Security and pension are only giving me 30 grand. I need to come up with another 70 grand of income to cover just my basics. That's a bad example. Let's assume 50 grand is your basics. So again, 30 grand Social Security and pension, 50 grand is your required food, transportation, housing, taxes, healthcare, things you can't do without. If your portfolio ever depletes, you have a $20,000 deficit where you're not covering your basics. That's a bad spot to be in. So maybe in that scenario, you consider buying an annuity that can eventually produce for you 20 grand per year of lifetime income. So now between your Social Security, your pension, and your annuity, you'll have $50,000 per year for life, guaranteed, coming in like clockwork, that you can use to pay your $50,000 of necessary expenses every year for the rest of your life. That's a situation where, again, consider an annuity to buy some guaranteed lifetime income to supplement Social Security and or pension. That's scenario two. Again, MYGA. Two is buying income. Three is potentially using an indexed annuity as an alternative to the bond portion of your portfolio. In this case, you're not buying the annuity for income necessarily. You are buying it for its long-term growth expectations. Again, an indexed annuity, depending how it's structured, should hopefully get you 3 to 5% per year on average, with no risk of loss, assuming you don't take it out early. That's not a bad return, right? For bonds, in the context of bonds on average, that's a reasonable bond expectation. Now maybe a little lower considering how low interest rates are. But if you can hopefully get 3 to 5% with bonds with some other risks involved, or get a guaranteed of no loss and hopefully get 3 to 5% over the 10 years or whatever in an index annuity, that's a fair alternative. Now, I wouldn't use an index annuity for the entirety of your bond allocation, but if it's not a bad idea for some of it, especially if you're a lower risk tolerance person. Now, I'm not saying everyone should go out and buy some index annuities to replace some of their bonds. No, it's not necessary, especially if you have a lot of assets, if you have a lot of Social Security and pension relative to your expenses, if you have anything more than like a real conservative risk tolerance, you may not need to consider this indexed annuity alternative to bonds. I'm just saying it's the kind of the third scenario where I think annuities can make some sense if you want to swap out some of your bonds and replace them with an index annuity that should give you bond-like returns, but with no risk of loss. That's the third time to consider it. So that's what I was saying. Whoever this person is here, I honestly struggle to see where variable annuities make sense. It's like index annuities I get because no downside, modest, but some positive upside. I can see the value in that. Variable annuity is an investment in that it can lose value, but it's saddled with these fees and other bells and whistles. I think it's like, if you want an investment, just get an investment. Get off the fence. Don't half-ass it. Either get an investment, or if you're not willing or able to take the risk, get something with some guarantees, some floors, some backstops. Right? A variable annuity is probably not for you then. The only time variable annuities start to make sense is if you start tacking on those riders and get all these guarantees and bells and whistles and the ability to guarantee yourself some withdrawal down the road for the rest of your life. But that all comes at a cost. As I showed in that example, it's not uncommon to have like 4% per year fees in variable annuities when you add all the stuff up. So I don't see it. It's like, pick one side or the other. You can't have your cake and eat it too. It's like, you want some investment, so you buy a variable annuity, but you don't. You're concerned about the growth. So now you're paying that much extra to buy this guarantee to it, and you're kind of like diluting the benefit of both. So, I don't know. Not to say variable annuities never work, never make sense, but compared to the other options out there, I just struggle to see how to come up with a case for them. Good question though. Why the dad's penalty box? So that's something my kids got me. You're supposed to put a quarter in. It says dad jokes. So anytime you tell a bad joke, you're supposed to put a quarter in. At the rate I'm going, that thing will have like $1,000 in it. But no, that's just really just decoration at this point. Good observation. What are your opinions on flexible premium deferred annuity? What are their costs? The more words there are in the title, the more you have to really stop and think. Insurance products, I got to give it to insurance companies. They're really, really good at marketing and creating and innovating and coming up with features and bells and whistles and fancy names. But the more words, the more features, the more bells and whistles, they get so complicated that the majority of people aren't going to understand what they have. Anyone I've ever seen that has an annuity who's not in the industry, who's not a mathematician, who's not a finance person, they don't fully understand their annuity. They did, or they thought they did when they first bought it, and the salesperson showed them this glossy presentation. Here's what happens. This happens. This happens. And yeah, sure, it probably made sense at the time. But fast forward a year from now, you don't remember this stuff unless you go back and look at the 80-page contract to refresh your memory. Where am I going with this? Yeah. So anyway, flexible premium deferred annuity. That just basically means like you can put in some amounts here and there. You don't have to just drop in a lump sum and that's it. You can put in $100,000 today, $5,000 next year, $20,000 the next year. it's like any annuity, honestly. It depends why you're buying it. What is it about flexible premium you want or need? The bad thing about annuities, more times than not, they're sold instead of bought. Let that soak in. It means, the people who sell them are out pushing it on people, as opposed to people saying, hey, I need a product that does this, that, the other. Let me go find it. No, that's how it should work, right? People should know, okay, these are my specific set of wants and needs. Let me find an annuity that does it all. That's how it should work. Usually it's the opposite. Usually, the person who sells it, their new incentive from their wholesaler is, hey, go sell this particular product. There's a higher commission on it if you sell this. So they go out and find reasons and opportunities to sell it. So annuities are often sold more than they're bought, is what that means. Anyway, so my question to you is, whoever this is, first of all, how did you come across a flexible premium deferred annuity? I'm assuming it wasn't on your own doing. They're not necessarily bad or good. It's like everything I discussed tonight. They all sort of have their place. They all have their benefits. They all have their pros and cons. It depends why you're buying it, why you want the flexible premium option, why you want deferred versus immediate. So I can't say whether it's good or bad. It's not anything. It all depends on the context of why you want it and what it's going to do for you. Okay. Question about Social Security again. Oh man, here's out of left field. All right, so it looks like we're done with annuity questions. So I'll take these couple of stragglers just for the fun of it. If I made my money in California, if I moved to Texas, will my 401k be taxed when I withdraw? No. Well, federal tax, yes, but state tax, no, it should not. So long as you do duly, properly re-domicile, don't just have a vacation house in Texas, but actually move, change your license, change your voter registration, change your bank accounts, own a house, right? Or rent, have a contract to rent. If you truly change your residence, then no, you will be under Texas's state tax rules, of which there is no income tax in Texas. So your 401k withdrawals will not be taxed in Texas. They will be taxed federally still. And there's other state arbitrage you can do. So I'm in New Jersey, Pennsylvania is right next door. Pennsylvania does not tax retirement income, pensions, IRA withdrawals, 401k withdrawals. So there are some people who make their money in New Jersey, typically a higher wage state than Pennsylvania, and then retire to Pennsylvania, and they save themselves some state income tax because they don't have to pay tax on IRA 401k withdrawals. So same sort of thought process you have here, poster. All right, so back to Renell's question about Social Security. So again, I'm done with, looks like we're done with the annuity questions. God, where'd it go? I lost it. So, and the question was about Social Security trust fund anticipated to deplete in 2034. I'm just going to see if I can find it. I cannot find it. Oh, here we go. I read an article stating Social Security is predicted to run out by 2034. Sort of true, sort of not. What do you suggest to people that are nowhere close to retirement age by that time? So Social Security is not going to stop. Payments will not simply dry up. That is not true. What is true is the trust fund, the pot of money currently sitting in Social Security, is anticipated to run out by 2034. That is factually accurate. But even when it does, Social Security itself will not stop. There will still be enough money coming in from payroll taxes and from income tax paid on Social Security that it's anticipated Social Security will still be able to pay out like 80% of everything they promised over the next 75 years, I think. So worst case, if and when the trust fund runs out by 2034, if there's no changes made to the Social Security system, yes, payments need to be cut across the board potentially by 20%. Now, my guess is, well, first of all, there will be changes prior to then. It may be the 11th hour, but there will be some sort of changes to help bolster or change the system. That's my guess. And even if and when there are benefit decreases, I cannot fathom a world where they actually take money away from people already on Social Security or very close to it. Late 50s, early 60s, I don't know. But just, picture the scenario, someone limited income, their sole source of income is 30 grand of Social Security, maybe some bank interest, I don't know. I just don't picture the government saying, hey, we're taking 20% of your payments away. that would be bloody murder. Heads will roll in Washington, especially if you do something against one of the largest voting blocks, like people in their 60s and older. So anyway, so that's my thoughts. The trust fund, yes, it may run out, but no, payments aren't stopping, though they may be reduced. But there will be changes prior to then that will change something. So what I suggest to people that are nowhere close to retirement age, I don't think you should consider Social Security as not being there. Yes, assume it will be reduced for you. Like if you're only in your 20s or 30s, it'll probably be less than what's shown on your benefit statement now. But what to do about it? You just got to save more. I mean, for better or worse, companies are getting away from offering pensions. They're putting the onus and the risk on you, the employee, the individual, to fund your own retirement, right? Companies are getting out of the pension game. Social Security is clearly strained, so you can't rely solely on the social backstop of Social Security. It's up to you to save diligently, live below your means, do the best you can to save, invest, play it by ear as you approach retirement. There will be legislative changes, financial markets will change, your own personal circumstances may change. So just, save as much as you can reasonably between now and then, because it's going to be increasingly on you and me and each of us individually to fund our own retirements going forward. All right, looks like, what else we got here? Oh, what is this? What's on your t-shirt? A trailer and, oh yeah, good question. What is it? It is a trailer and a flamingo and a little grill. Oh, so let me say this announcement. So this is Rock Retirement Club. Roger Whitney, some of you may have heard of. He's got a great podcast called Retirement Answer Man. It's been around 7-8 years. He also has this really cool paid membership group called Rock Retirement Club, where people join, and it's this community. There's lots of great resources and education and all sorts of office hours and Zooms and master classes and download and software, whatever. This shirt, this is one of the shirts from the Rock Retirement Club. I thought it's cool. Got really great fun images. I was a special guest this past Monday on one of their local, their Zoom meetups for club members. So I got a shirt from my being part of that group. So anyway, that's what that is. Okay. That's exactly it. Hoard your money. Yeah, for better or worse. Again, it's on you. Don't. None of us can be dependent on companies, on the government for our retirement. At least not all of it. Again, Social Security will still be there to some extent, but it's increasingly on our own shoulders. All right, looks like we are done there. So cool. This went well. Hopefully, I know I dumped a lot on you all. This will be saved. I'll post a video after. I may further break these down some point down the road and get a little more in depth about these. I kind of glossed through it just because there's so much content, but hopefully you found it helpful. Next week will be another monthly mailbag, which is random Ask Me Anything. Good for me because I don't have it, no prep time for me, but curious. I'm sure I'll get stumped on some questions. So next week, same place, same time, 8 o'clock Eastern. Bring your questions, ask me whatever. If you have questions ahead of time, send them to me. You can Facebook chat or my email, which you can find on my company website, Tenon Financial, TENON financial.com. You'll see a contact us. You can send me questions that way. All right, that's a wrap. I will see you all next week. Good night.